Imagine a time before the Federal Reserve, before standardized currency, a time when banks sprouted like mushrooms, each printing their own money. This, my friends, was the era of wildcat banks in the United States. These unregulated institutions, operating primarily in the 19th century, offer a glimpse into a period of American history marked by both economic opportunity and financial chaos. Wildcat banks were essentially privately owned banks that issued their own banknotes as currency. These notes were often backed by questionable assets, and their value fluctuated wildly, creating instability in the burgeoning American economy. Today, the term wildcat evokes images of untamed wilderness and unpredictable creatures, a fitting analogy for these financial institutions that operated with little oversight. The story of wildcat banks is a fascinating study in the interplay of ambition, risk, and the consequences of unchecked financial speculation. It's a stark reminder of the importance of regulation and oversight in maintaining a stable and trustworthy financial system. To understand the emergence of wildcat banks, we must journey back to the early 19th century. The United States, a fledgling nation, was experiencing rapid westward expansion and economic growth. Demand for capital was high, but access to credit was limited. The first Bank of the United States, chartered in 1791, provided some financial stability. However, its charter was not renewed in 1811. This created a void that state-chartered banks rushed to fill. These banks, operating under various state regulations or lack thereof, began issuing their own banknotes. While some banks operated responsibly, many took advantage of the lax regulatory environment. They issued notes far exceeding their reserves, hoping to profit from the difference. This practice, coupled with the lack of a national currency, led to a confusing and unreliable monetary system. The name Wildcat aptly captures the essence of these banks. Many were located in remote, sparsely populated areas, far from centers of commerce. This made it difficult for note holders to redeem their notes for specie, gold or silver. Think about it. You're a merchant in Boston and a traveler pays you with a banknote issued by a bank in, say, the wilds of Michigan. You have no easy way of knowing if the bank is solvent, or if the note is even worth the paper it's printed on. Adding to their shady reputation, some wildcat banks resorted to unscrupulous tactics. They might operate only when bank examiners were not around, or they might circulate counterfeit notes from other banks. These practices further eroded public trust in the banking system. Section 4, Economic Roller Coaster, the impact of unregulated banking. The proliferation of wildcat banks had a profound impact on the American economy. On the one hand, they increased the money supply, which fueled economic expansion. New businesses could access credit and Western settlements could flourish. However, this growth came at a cost. The unregulated issuance of banknotes led to rampant inflation. The value of goods and services soared, while the purchasing power of wages eroded. Imagine going to the market one day and finding that the price of bread has doubled. Moreover, the instability of wildcat banks contributed to a series of financial panics. When one bank failed, it often triggered a domino effect, leading to widespread bank runs and economic downturns. The Panic of 1837, for example, was fueled in part by the collapse of many wildcat banks. Section 5. Tales from the Wild Side, Anecdotes of Wildcat Banks. The era of wildcat banks is replete with colorful anecdotes that illustrate the precarious nature of these institutions. One such story involves a bank in Michigan that supposedly kept a cage full of wildcats on its premises to deter potential bank robbers. Whether true or not, the story highlights the lengths to which some banks went to project an image of security. Another anecdote tells of a group of savvy investors who bought a large quantity of discounted banknotes from a failing wildcat bank. They then traveled to a remote town where the bank was located and redeemed the notes for specie, making a tidy profit. These stories, while entertaining, underscore the lack of regulation and oversight that characterized the era of wildcat banking. They serve as cautionary tales about the importance of financial stability and the potential consequences of unchecked speculation. Section 6. The Legacy of Wildcat Banks, Lessons Learned and Regulations Born. The era of wildcat banks eventually came to an end with the passage of the National Banking Act of 1863. This act established a national banking system and created a uniform national currency, bringing much-needed stability to the American economy. The legacy of Wildcat banks is a mixed one. On the one hand, they facilitated economic growth and westward expansion. On the other hand, they contributed to financial instability, inflation, and economic crises. The Wildcat era serves as a reminder of the importance of a sound and well-regulated financial system. It highlights the need for transparency, accountability, and prudent lending practices. The lessons learned from this period continue to shape financial regulations today, ensuring a more stable and trustworthy banking system for generations to come.